Yes, that is a welcome sound to Forex Winners Club. In this channel, we endeavor to teach you all we can so that you can become a consistently profitable trader. This being video number 2, where we present and talk about essential concepts, or what you might call fundamental concepts in Forex trading. Just like any other business, you cannot dive in straight and hope to make money if you don't understand the language used in that particular business. Forex is like any business. There are terms you must be familiar with. And this video is about those specific terms. It is actually part 1 of the key terminologies used in Forex. And you need to know these terminologies if you are planning to trade Forex successfully. Ignore the key terminologies and you're going to suffer throughout in your Forex trading career. Okay, so that being said, the basics of Forex, like I mentioned, this is part 1. We cover the basics, and this is a video very critical for beginners. And for advanced traders, you may want to refresh your mind on these concepts because we simplify them. Key terms to be covered here are Forex and Forex trading, currencies, major currencies, and I hope minor currencies too. We'll talk about the Forex market size and the market liquidity. We talk about how to make money trading Forex. There are terms such as bid price, ask price, and the spread. Then we'll talk about how to determine when to buy a currency pair or when to sell a currency pair, because that's how we make money. And finally, we'll cover probably a common word you've heard around. It's everywhere in Forex forums, it's YouTube channels, blogs, the word Pip. And we'll still talk about Pipettes and Pip Value. And so, with that being said, we dive in straight and see what there is. Okay. Now, what is Forex? Which is also sometimes known as FX in short. But of course, the longer way of writing it is foreign exchange. Forex, foreign exchange. No, foreign exchange, or Forex as it is simply referred to, this is the global market where people, you and I as traders, exchange one currency for another currency. I exchange one currency for another currency. You exchange a dollar for a yen, a pound for a dollar, a euro for a dollar. That is the language you speak in Forex. You exchange one currency for another. For example, when you are crossing from one country to another country, let's assume you are in Australia and you want to go to United States of America. And in Australia, you use the Australian dollar, AUD, okay? But in the US, they use the United States dollar, USD. Now, you cannot use AUD in US, and you cannot use USD in Australia. I'm assuming that's the case. That means when you leave Australia, you want to move to United States, at the border or at the airport or where they clear, before you cross the border, you've got to convert your Australian dollars into United States dollars. That way, when you get to the US, you will be able to transact in the currency being used in the United States. Okay? Similarly, now once you finish your trip from US and you want to go back to your country, Australia, you need to convert the United States dollars that you were using then back to Australian dollars that you would want to use back in your home. Simple? Clear? And this happens quite frequently in Forex exchange bureaus, banks. They allow you to change one currency for another. Okay? Now, The Forex market is the largest market we have. We have several other markets like stocks, okay? But the Forex market is the largest market in the whole wide world. Why? Compared to other markets like stocks, the Forex market trades a volume of about $5 trillion US dollars per day. The other markets that are even that try to be anywhere closer are in billions, not in trillions. Now, we talk about buying and selling currencies. What is a currency? I got this definition from a dictionary online that currency refers to a system of money in general used in a particular country. So you can call it the money you use in your country. If you are in UK, you are probably using the pound. If you are in the United States, you are using the US dollar. If you are in Canada, you are probably using the Canadian dollar. If you are in Switzerland, you probably are using the Swiss franc. Okay? So it's the currency. Currency refers to this system of money you're using in your country. Okay? Sorry. And therefore, Forex trading itself refers to the concurrent or simultaneous act of buying one currency and selling another currency. Now, that looks a bit interesting because we need to remember also, number one, that currencies are always traded in pairs. Currencies are always traded in pairs. You don't trade a currency in isolation. Currencies are traded in pairs. For example, when you have using the example I gave for Australian dollar versus the US dollar, for you to be able to get the US dollar, you must be having the Australian dollar. So you have to sell your Australian dollar to buy the US dollar. And when you're coming back from US to your country, Australia, now you have US dollars. That means you have to sell the US dollars that you have to buy Australian dollars. Okay? So Forex trading, which is what I'm explaining using that example, involves pairs. One currency in the pair must be bought and the other one must be sold simultaneously. Or one has to be sold and the other has to be bought simultaneously. That's why we are saying Forex trading is the concurrent act of buying one currency and selling the other currency. It's that simple. For example, if you want to trade Euro USD, now we are talking about pairs here. You are trading the currency used in the Eurozone, Euro, against the currency used in the United States or America, that is USD. If you want to trade this pair, then you must make a decision on whether you are buying or you are selling. Now you buy, as I'm going to explain later, if you buy this pair, the language you would hear in the Forex market is the word going long. When you hear traders saying, I'm going long or I've gone long on Euro USD, it means they have bought the Euro, okay, and sold the USD. The process happens at the same time. All you know is you bought the Euro, but the broker handles the other part silently. They sell the USD. Okay? In a similar manner, you hear people talking about going short. Now, going short is the reverse of this. When you go short on Euro, USD, when you go short, it means you are anticipating that the Euro is becoming weaker against the USD. Okay? So that is selling, going short. Those terminologies will come much later. Now, you would be hearing things like uptrends and downtrends. An uptrend happens when a currency pair like Euro USD is, the exchange rate is moving up and up, increasing in value, that is. And a downtrend occurs when the value is depreciating. The price is moving down. That is considered a downtrend, of course. When it's moving up like this, that's considered an uptrend. Okay? And when it's moving up, down to the same level, up, same level, down again, like this, then we say it is ranging, moving within the same range. It's not breaking out of that range. We'll talk about those things in other videos that will come later on. So we carry on. In Forex, we trade money. If someone asks you, what are you doing in trading Forex? You trade money. You use your money to buy a currency, and use your money to sell a currency. That's all there is. Now, these currencies we are talking about as being systems of money in general used in a particular country. Let's look at these pairs that you'll be trading. Currencies are paired because we said you must buy one and sell the other simultaneously. Now, we have categories of these currencies. The pairs that contain USD are called major pairs. A currency pair that contains USD needs. Look at all these 7 currency pairs: Euro USD, USD JPY, GBP USD, USD CHF, USD CAD, AUD USD, NZD USD. The 7 pairs you see here, they are also pronounced as their nicknames given to them, okay? Euro USD is also just like Euro dollar, because dollar is the, we know dollar for US mostly, okay? USD JPY is also known as the dollar yen. USD is the dollar. This is Japanese yen. So this is the pound used in UK against the dollar in US. So pound dollar. This is the dollar used in US against the Swiss franc used in Switzerland. So we say dollar Swiss. Then this is the dollar as used in America versus Canadian dollars used in Canada. So we say dollar loonie. Okay? Although you can say USD card. Then this is Australian dollar versus United States dollar. That is, Australian dollar is also known as Aussie or Aussie. Depends on how you pronounce it. Aussie or Aussie. Here people popularly say it's the Aussie. The dollar is the one in red here, the American dollar. This is the New Zealand dollar, NZD, versus the American dollar. So we say Kiwi dollar. NZD is also known as Kiwi. These are nicknames, yeah? The USD is the dollar. The euro is euro. The CHF is the Swiss. The NZD is the Kiwi. The AUD is the Aussie or the Aussie. And, the Canadian dollar is the loonie. Okay? You don't have to know these things, really. But knowing them would help you, improve how you communicate with fellow Forex traders. They might be using these names or these, nicknames. You could be asking, why are they even, in this manner? Why are they 3 letters in each case? Like Euro, USD, USD 3 letters, JPY 3 letters, CAD 3 letters. What is all this? The first two letters in a currency indicate the region or the country where the currency is coming from. So EU is Eurozone. US, this is United States. AU, this is Australia. NZ is New Zealand. CA is Canada. CH, this is Switzerland. Interestingly, they don't match. And JP is the code for Japan. Yes? Now, with that aside, the last letter for each 3, remember each currency is given 3 letters. The last letter indicates the name. It is the name of the currency being used in that country. The D in USD is for dollar. So we say US dollar. The Y in JPY is yen. So Japanese yen or Japan yen. The D here again is Canadian dollar. The D here, Australian dollar. The D here, New Zealand dollar. The P here is the UK pound. I want to believe GB is Great Britain. The pound. Okay. Now this one does not follow that method of naming, R, and also this one. It's a Swiss franc, but you see F is nothing associated with it in this case. Okay? The currency is called franc. Yeah, so it's okay. A franc. So this one is fine. It's a franc. Swiss franc. Okay. So that is it for you to know the basics. So what you need to take away from this slide is these are the major pairs you are likely to be trading most of the time. These ones. You are likely to be trading these pairs most of the time. A because they are the ones with the highest volumes. Now, minor currency pairs are those without the USD. Remember, major currency pairs have USD. There are pairs with USD. But we also have currencies without USD. For example, Euro, GBP, there's no USD. CHF, JPY, no USD. GBP, AUD, no USD. So without the USD, which is the major currency in the world, the strongest currency in the world, you might want to say, or the one that is popularly used across the world. Now, without it, these other pairs are always called minor. Okay, so this means euro, pound, euro, pound, euro, franc or euro Swiss, euro, Canadian dollar, euro, Australian dollar, euro, New Zealand dollar, euro, Japanese yen. You can keep on naming those things. This is the pound Aussie or Aussie, the pound Australian dollar. And there are many others. We have at least 28 currency pairs. You can already see we had 7 here. Now we have 5 and another 5 and another 4. This is 14 plus 7. We already have 21 from this, combining the minor ones and the major ones. Okay. Now there are those that do not fit in any of these categories. They are usually, or a combination of these, they are usually called exotic currency pairs or crosses. Don't worry so much about the same. Now let's move to another concept called the Forex market size. You would like to know the size of the Forex market? More especially, you need to know how it is possible for you to trade Forex. Now you need to know that Forex is traded over the counter, OTC. Traded over the counter means there is no like head office for it, Forex. There's no head office. There's no central location where trades are handled from. No central exchange, no physical location. So we trade over the counter. And that's why trades are executed immediately. And that's why we say they are spot Forex. Now, spot Forex, spot FX market allows you to trade immediately or on the spot at the current market price. So you want to buy, you can buy immediately. You want to sell, you can sell immediately. There are no things that restrict you. Now, why the Forex market is beautiful to trade, maybe when compared to other markets like stocks, is because the market is simpler to trade than stocks. Simpler in terms of how much you need to start, simpler in terms of how to execute trades, and several other aspects of simplicity. There is high liquidity. There are so many currency pairs like USD. Look at the volume of USD in the market. 85% is this is the most traded currency. So it occupies it participates in most of the transactions. 85% of the transactions will always have a USD in them. 39% of the transactions will always have a euro, thereabout. 19% of the volumes traded in Forex will have a yen, Japanese yen. And you can see the trend goes on with the pound coming next, the Aussie coming next, the Swiss franc, then the loonie or the Canadian dollar following. Of course, others would be that category. Okay. So brokers allow you to start a trading account with as low as $50, even $100. More about that later on. For now, just hold that. We talk about tight spreads. We'll talk about spreads later on. You can trade Forex around the clock, Monday to Friday, any time of the day or night. You can trade Forex. Okay? You can trade Forex. So we move on to how to make money trading Forex. Now, what is the objective of trading Forex? We trade Forex with one objective: to make profits or to make money. But how do we make money? By exchanging one currency, okay? By exchanging one currency for another. We simply exchange one currency for another. That's the key word. In other words, if it's Euro USD, you are buying Euro and selling USD, or you are selling Euro and buying USD. Simple. You exchange one currency for another, with the hope that after you've done the exchange, before you close the trade, price would have moved in the direction you anticipated. We talk about that later. In terms of uptrends, downtrends, and price movement. That will come later on. For now, just understand we must exchange one currency for another for any profit or even loss to be realized. Okay. So when you say, for example, you want to do a buy, you want to buy a currency pair, you are buying, meaning the price at which you are buying that pair will be lower than the price at which you are going to sell it. The difference between the selling price and the buying price would be used to indicate your profit. Similarly, if you are doing a sell, it means you are anticipating that price will depreciate. Okay, and for that reason, you sell at a price slightly higher than the price at which you are going to buy back the the currency, so that you close your trade. We'll explain those things later so that you understand them much better than in this example. So let's look at an example on how you make money trading Forex. Look at this example. Here, we have a scenario. We are dealing with two currencies. We are dealing with the Euro and we are dealing with USD. So our pair is Euro USD. Okay. Here we are dealing with Euro USD. That is the pair we are working with for this illustration. Okay. For this illustration, that's the pair we are working with. Good. So with Euro USD, what you are doing in this trade, in this particular example, is you buy 10,000 euros. Look at this. You're buying 10,000 euros. That is Euro, that is USD. Now, whenever you see currency pairs indicated, they're always indicated as pairs, of course. The first one is the base currency. We talk about it later again. The second one is the quote currency. So it's like the first one is 1 in exchange for a number of the second. For every 1 euro, how many USDs do you need? So in this case, it means for every euro, you need 1.1800 USDs. Pull out your calculator and you will notice if we have to do this. Let's see whether we can do this calculation here. Let me pull out a calculator that we demo this. Let me pull out my calculator here. Okay. So my calculator is here. So we are buying 10,000 euros at a price of 1.18 USD. In other words, for me to buy euros, I will use dollars. Remember, we said in Forex trading, you buy and sell at the same time. So I cannot get euros if I don't have another currency. So to buy 10,000 euros, I will need an amount of dollars. Now the exchange rate indicated is for every 1 euro, I will need 1.1800 USD. So for 10,000 euros, how many USDs do I need? Simple mathematics, 10,000 euros multiplied by the exchange rate, 1.1800, and that tells me I will have to use $11,800 for me to buy 10,000 euros. Okay, so I've now bought my euros. I've bought 10,000 euros. I have them. Are we there? Now, after some time, I want to sell back my euros and get back my USD. Remember, I bought. For the trade to end, if you bought, you must sell. If you had sold, you must buy. Okay, so here in our case, we bought euros using USD. Now we have USDs. Okay, I want to buy back euros. Okay, are you getting it? So in that case, if I'm going to buy back euros, then I will apply the exchange rate as at that point in time. Okay, so I have my euros now, which I had bought with USDs. Now I want to convert back to USD. Remember, when the trade began, we had USDs. We used them to buy euros. Now, after some time, we want to go back to our USD, but we have euros, so we must sell the euros. So in this case, we have 10,000 euros, which we bought earlier. We multiply by the exchange rate, 1.25. You notice the exchange rate has changed. Here it was 1.18. Now it's 1.25. It has increased. So now I end up with $12,500. Remember, initially I had $11,800, but now I have $12,500. If I subtract the previous amount, I would end up with $700. So through this, foreign exchange, through this exchange of USD for euro or euro for USD, I've ended up with a profit of 700 US dollars. That's how we make money. You buy when the price is low, you sell when the price is high. Can you see that? To simplify, you bought euros when the price for a euro was low. You wait for the price of euro to increase, then you sell your euros and you get more USDs. Great. Up next, we talk about bid price, ask price, and the spread. Now, you have noticed so far, we'll use an example somewhere here, okay? You have noticed that every time we are quoting price, there is always an exchange rate. Every time we are quoting a currency pair, there is an exchange rate for it. But let's do away with these terminologies to start with. A bid price is considered to be the price at which your broker will buy your base currency, the currency you want to trade, assuming you want to trade the Euro USD. Okay, let's say, again, you want to trade Euro USD. Let me get a Euro USD somewhere here. Okay. Okay. So you want to trade Euro USD. So for you to buy a Euro, it means you are going to sell a USD. Remember, we are always buying and selling at the same time. You buy the base currency, you sell the other one, quote currency, and vice versa. So for you to buy anything from the Forex market, a broker will have to sell it to you. And for you to sell anything into the Forex market, a broker will have to buy it from you. Please get that first. Every buy involves a sell. Every sell involves a buy. And who facilitates that? A broker, a Forex broker. That is the entity, a company that will facilitate a trade. Sorry, I'm having a flu and my voice seems to be, a little bit becoming messy. So bid price is the price at which your broker is willing to buy your base currency, in this case euro, in exchange for your quote currency. No, in this case, the broker is the price at which the broker buys a euro so that the broker gets a USD. You are exchanging one for another. You buy this one to get this, or you sell this one to get this. So in this case, the broker buys euro in exchange for USD. Now you do the reverse as a trader. For you, as the broker is buying euro, okay, in exchange for USD, you are selling euro in exchange for USD. So bid price means two things, which are one and the same really. Bid price means the price at which the broker buys your base currency in exchange for your quote currency. At the same time, bid price is the price at which you will sell the base currency to the what? The price at which you will sell to the Forex market. It is the price at which the broker buys, but it's also the price at which you as a trader, you sell. Now, ask price is also called the offer price. It is actually the reverse of the bid price, more or less. Now, ask price or offer price is the price at which your broker is willing to sell the base, in this case euro, in exchange for the quote. It's actually the reverse of the bid price. Similarly, if the broker is now selling the base currency, you are the one buying. Okay. So in terms of trading, you think bid equal to selling price. Okay. Ask equal to buying price as a trader. But as a broker, the reverse. Bid is buy, ask is sell. Now the difference between, because price changes after you bought it. If you bought it, for example, using the ask price, you are going to sell it using the bid price. Okay. So in that case, price will have changed because the exchange rate changes from time to time. It's never constant as such. So that fluctuation results in a difference between the bid price and the ask price. The difference between these two, the price at which you bought and the price at which you sell, or the price at which you sold and the price at which you will buy back, is called spread. Think of it from a layman's perspective, using business, ordinary business or commerce. It's the same as the selling price minus the buying price. Okay? The spread is like the selling price minus the bid price. Now look at our image here. Whatever currency pair is here, don't worry. The bid price, remember we said the bid price is the price at which you sell to the market. The ask is the price at which you buy from the market. Okay? The difference between these two, you can take the greater, ask minus bid in this case. You just ignore the negatives in this case, even if you were to subtract the other way around. So it's 101.20 minus 101.15. The difference is 5. Okay? There's a difference of 5. Don't worry about the decimals. It's still 5. Okay? So the spread is 5. Now, moving next, we talk about this. That currency exchange rates, when you buy a currency pair, like Euro USD, this one, when you buy a currency pair, you simultaneously sell another currency pair. That's an interesting way of looking at things. In the above case, we're actually not talking about pairs, but a currency at one currency in a pair. Sorry for that confusion. Now, in the above case, you buy Euro and sell USD. So this is a pair. When you are trading a pair, you buy one of the currencies in the pair and simultaneously sell one of the currencies in the pair. So to buy Euro USD means you buy Euro and simultaneously sell USD. To sell Euro USD means you sell Euro and buy USD at the same time. The broker handles this. You don't have to worry so much about any of those. Now, what makes price move up or move down? There are demand and supply forces in the market as dictated by major banks. So don't worry. Later on, you'll be able to talk about what moves the markets. But for now, just understand the first currency in the entire quote of a pair is the base currency. And it's always given a value of 1 in the ratio. In the exchange rate ratio, it's 1. The second currency in the pair is called the quote currency. Base quote. Base quote. Good? So let me circle them. The base, the base. Are we there? Let me change the color now. Again with this. The quote currency, the quote currency. Good? So that's how we look at it. Those in blue are the quote, and those in red are the base currencies. So bid price is the price at which you sell the base. So for you, this is the base. The price at which you sell a USD is called the bid price. The price at which you sell Euro is your bid price. Similarly, the price at which you buy, okay? The price at which you buy the base currency. So in this case, the price of buying USD is the ask price or the offer price. The price of buying Euro is the offer price or the ask price. So if you are buying the base, it's called bid price. If you are selling the base currency, it is called the ask price. Fair enough? We'll move on. Now, how do you determine when to buy or sell a currency pair? Simple. In later videos, especially when we start talking about analyzing markets, you will learn about technical analysis. There are indicators we use in the market to help us determine whether the price of a given pair will move or will be appreciating. The value actually will be appreciating or depreciating. All right. In other words, one pair is becoming stronger than another, and then you buy, or as one is becoming weaker than another, you sell. We'll be able to see the arrangement in which you check. Now, technical analysis enables you to determine whether you can buy a pair or you can sell it. Fundamental analysis, this is when you follow economic news, for example, like what happens to the US economy and how does that affect the USD? And after it has affected the USD, how does the USD influence the currencies it's paired with. For example, when USD is very strong, what happens to a currency pair like USD JPY or a Euro USD? So that's fundamental analysis, usually driven by high impact news. Sentiment analysis comes in from what people think of a given asset or a given financial instrument. So in this case, if people have been talking about the US, people have been talking so much about the US, those sentiments or those opinions might affect how the US performs, the USD performs. If there's something happening in the Eurozone and people have been talking negatively about it, you may expect the euro as a currency to depreciate in value. That's based on what people have been saying or thinking it is, because human beings are driven by emotions a number of times. Now, for you to buy an order in the market, for example, you want to buy USD JPY. Remember, when I'm saying you are buying the base, selling the quote. Okay? You only do a buy if you are hoping or you believe that the United States dollar will perform better than the Japanese yen. In other words, you do a buy when you believe that the base currency will become stronger than the quote currency. Okay? Similarly, you sell a currency pair, for example, Euro card here. You will sell Euro card when you believe that the base currency will lose value against the quote currency. So in other words, Euro will depreciate in value as Canadian dollar appreciates in value relative to this other. Okay? More about that when we get into trading. Now we talk about a concept called pips and pipettes. Now, currency pairs are given exchange rates. On your charts, when you start analyzing charts, you'll see these pairs being mentioned or being quoted with a number of decimal points. Majority of brokers will give you currency pairs with a price or an exchange rate of 4 decimal points, sometimes 5 decimal points. Now, a pip is considered to be the smallest unit of price for any specific, the smallest unit of price for any specific currency. That's what we are calling a pip, this guy here. Okay? Now, if you look at Euro USD, what we have, if Euro USD is quoted as 1.1645, and again, I'm reminding you, this means for every 1 euro, you will need 1.1645 USDs. Okay? Now, you look at the fourth digit. That's where the pip is. Now, the fourth digit is 5. If it moves from 5 to 6, we say it has moved by 1 pip. Even if it still moves from 5 to 3, it has still moved. So it's 5 minus 3, which is 2 pips. So a pip is the smallest change in the value. Okay? Now, for most currency pairs, and indeed currency pairs that do not have what? That do not have the yen. But now for currency pairs that have the yen, the Japanese yen here, JPY, they are usually quoted in 2 decimal places or points. In this case, like C, 112.75, not 4. So when it is like this, the second decimal place or point is your pip. So in this case, the pip is at 5. If price moved from 0.75 to 0.76, we say it has increased by 1 pip. If it moved down from where it is, 0.75 to 0.70, we say it has decreased by 5 pips. Now, some brokers do not have the 4 digits. Instead, they have 5 digits. And in that case, they also don't have 2 digits for JPY pairs. Instead, they have 3 digits. Now, where a currency rate is mentioned, a currency rate is mentioned using or quoted using 5 digits, the 5th digit is considered a pipette. It's a fraction of a pip or a fraction of pip. Let's pick an example. We have an example down here. In our example, look at this. Look at the price here. And look at the price here. I'll put 2 arrows. Okay. We have 1.0984. 4 is the fourth digit, which we said represents a pip for currency pairs quoted in 4 decimal points or places. Now, whenever we have more than 4, the fifth one is called a pipette. So in this case, 0 is the pipette, 4 is the pip. The alternative is seen here. 4 is the pipette, 5 is the pip. So the pip is usually the fourth decimal point for most of the pairs, or the second decimal point for yen pairs, like this one. Fair enough? You need to know that, that concept. Now, you need to realize then that a pip is equivalent to 0.0001 for those 4 decimal places in case of a pair with 4 decimal points, or it's equivalent to 0.01 for pairs with 2 decimal places. You need to know the value of a pip, okay? You need to know what is the monetary or financial value of a pip when price moves like from 0.75 to 0.78 by 3 pips. What is the equivalent in terms of currencies? That's what we are talking about in this video and in this section especially. Now, the value of a pip. Remember, every currency has its own value. The USD has a separate value from the pound. The pound has a different value from the Canadian dollar, for example. The Canadian dollar will have a separate or a different price and value than the yen. And for that reason, a pip has different values depending on the currency you're talking about. So example number 1 on how to to determine the value of a pip. Let's consider you are trading USD CAD with an exchange rate of 1.0500, reminding you this simply means for 1 USD, if you want to buy 1 USD, you will have to spend 1.0500 Canadian dollars. Are we there? Great. Now, in a case like this, you want to know the pip value. So in this case, you take 1 pip. This is my own formula. You take 1 pip, and a pip now depends on the decimal places we talked about, 0.0004 or 0.00 or 0.01, okay? So if it's 4 decimal points, it becomes 0.0001. So like for this one is mentioned or quoted in 4 decimal points or places. I'm mixing those two. All right, I'm not good at dealing with those things. But anyway, I hope you get the point. Now, for me to get the pip value for USD CAD, I will take 1 pip. 1 pip is mentioned as 0.0001 because this is quoted in 4 decimal points. I will then multiply that by the quotient. That means I will have taken 1. Remember I said this is 1. This is many. Okay? So I have 1 USD divided by 1.0500 CAD. 1 of this against 1.0500 of the second. So you divide that first. Whatever you get, you multiply by the pip. 1 pip was 0.0001. Then you multiply by the number of units of the currency you bought or sold. If you are trading a mini lot, we'll talk about lots later on, that will be 10,000 units. That would give you 0.95. In other words, whenever USD CAD moves by 1 pip, like now, if it moves from whatever price it is by an additional pip, you will see your account balance adjusting by 0.95, roughly. The second example applies the same concept, okay? But now here you are dealing with a Japanese yen, which we said is not in 4 decimal points. So in our case, in this case of this, you use 0.01 as your pip because there are 2 decimal points in this. So 0.01 multiplied by 1 of this, which has already been divided by 120 of this. Remember, this means for every pound, you need 120 yens. Okay? Then you multiply by the number of units you bought. So for a standard lot, a standard lot is it 10? It's supposed to be 100,000. Sorry for that. It's supposed to be actually 100,000 also. A mini would be less than that. Right. So anyway, don't worry so much about that. Just if the units you bought are 10,000, then that gives you that. If they're 1,000, it will give you that. Okay. Now let's look at pip value from another perspective. Maybe this will simplify your formula. To get the pip value of Euro USD, where the exchange rate is 1.0542, remember the pip is located at the fourth digit, okay? After the decimal, the fourth, in this case at 2. Euro is your base currency. USD is your quote currency. 1 euro, for you to have 1 euro, you need 1.0542 of USDs. For you to get 1 USD, you need 0.9485 euro. Remember, you remember the quotes, the bid and ask prices and exchange rates. They differ. When you are changing this to this, there's a different price. When you are changing this to this, there's a different price. That's why you see this. Now, a pip value will always depend on the size of the trade you are taking. That's why you saw previously I was talking about 10,000 units, 100,000 units, 1,000 units. Then value of pip is equal to, using this other formula, 1 pip divided by the exchange rate multiplied by the size of trade. Now, you don't even need to cram all of these things or know them really, because the broker handles that through the charting software that we talk about later. But it's good to understand this because you might need to be tracking your performance. So the formula given here is 1 pip. 1 pip, because this is a 4-digit quotation, we have 0.0001, 4 digits, okay? Divided by exchange rate, which is 1.0542, multiplied by the number of units you bought, 30,000 units. In this case, you end up with 2.85 euros. That's how you do it. Now, the quote currency and the base currency, together with the exchange rate, affect your account in many ways. Okay? And because the two are responsible for the movement of a currency pair up or down, results in a change in the number of pips you lose or gain, that will affect your currency, the currency in your account. If you open a USD account or a Euro account or a pound account, that you'll see your balance or your deposit increasing or decreasing. Now, your account's pip value, it means you may be having an account denominated in USD, pound, or whatever currency there is. It is therefore important for you to know that when a pip, when price adjusts itself by a pip or moves up by 1 pip or moves down by 1 pip, what happens actually to your account. So let's use the example of the pound yen we saw earlier on, where after you did the calculation here, we found that it was 0.83. That was the pip value, 0.83 pounds. But remember now, although this is the pip value of the GBP JPY pair you are trading, your account is in USD. It's not in any of these two. You are only trading GBP JPY, but your account is created in USD and it operates in USD. That means you would like to know eventually, how does this one translate to your base currency, the account's currency. Okay? To do that conversion, all you need to do is you take your current pip value from the pair you are trading, the one we calculated before here. Okay? You take that value, then you divide that value by what is called a quotient. A quotient. So in this case, you start by taking, so you have GBP, but you are converting GBP into what? USD. Remember, the pip value you had here before was in GBP, but you want to see the same value in USD. So that means you are converting GBP to USD. So you need an exchange rate for the two. And in our case, the exchange rate between GBP and the USD is 1.56. That means for every pound, you need $1.56. So we apply that concept and say, one of these divided by 1.56 of this will give you 0.64. And our formula says you'll take the previous pip value expressed in pounds, you divide that by the quotient of this. and that gives you 1.30. In effect, a pip, when you are trading GPP, JPY, a change in 1 pip is the equivalent of 0.83 pounds, but also it is the equivalent of $1.30 in your account. Because your account is based on dollars, you will see your account increase or decrease by $1.3 in that case. Another example here, you can pause the video and look at it. Now, later on when you talk about lots, standard lots, when you talk about mini lots, micro lots, and nano lots, generally for Euro USD pair, it is understood or agreed that if you are trading a standard lot, 1 pip means $10 in your account. So if you bought a pair, if you bought Euro USD and it increases by $1, by 1 pip, it means your account grows by $10. But if it decreases by 1 pip, it means you also have your balance decrease by $10. That is a standard lot. But if your account is a mini lot, it means for every pip price moves, the actual value is $1 moving. A micro lot is $0.1 and a nano lot is $0.01. Okay, you can read the example for USD JPY down here. It's not operating the same way as the Euro USD. As you can see for USD JPY, if it's a standard lot, 1 pip means $12.5. A mini lot would be, the same thing divided by 10. A micro is the previous one. A micro is a tenth of a mini lot, and a nano lot is a tenth of a micro lot. So you can see how the math keeps on adjusting. And that brings us to the end of part 1, where we were talking about basic terminologies used in Forex trading. Part 2 will cover lots. You need to know what a lot is, which I've just already mentioned here without saying what it is. We talk about margin. Extremely important, guys. You need to watch this. Because margin and leverage, if these two things are abused, you will blow your account faster than you thought it was possible. You must be careful with margin. You must be careful with leverage. Then we talk about transaction cost. How do you calculate the profit position size when you want to enter a trade? How do you decide how much you would spend in a trade? Okay, without risking your account. And then we talk about calculating profit and loss, because you are trading Forex to make money, but in the process you might also incur losses. It's important for you to know how to compute your profits and or losses in your successful trading. I believe this video has been informative to you. For more information, you can still go to babypips.com, a website I strongly recommend, which I've learned most of the things from as well. So it's a great site. You can go and check the materials there. It's free. Okay, but we'll be presenting some of these things, explaining them to you, demonstrating them. Sometimes text sometimes is not that good to consume, but when explained to you, maybe you understand much better. And that's why I decided that I will present this in a video where I explain things. And if you have questions, suggestions, you can always talk to me, and I will do another video to probably clarify things. Do note that these are merely basics that you need to master before we move to strategies. Don't jump into strategies before understanding things like leverage, things like margin. You will not make it, I can guarantee you. So you better get acquainted with these basic concepts. Then when you are grounded on them so well, you can move on to trading strategies and other things. Otherwise, until that next time, like in 2 days when I upload another video, bye bye for now, and thanks for watching our videos. See you in the next video.